Hello everyone, my name is Adriana Gomez. I'm going to speak about cross-border listing through capital asset pricing. Cross-border listing involves companies listing on the stock exchange of their home countries and also on a stock exchange in another country. A cross-border listing gives rise to the possibility of arbitrage. The arbitrage is the strategy of taking advantage of the price difference in different markets for the same asset. As a result, cross-border listing of stock have become popular among major corporations. Sarkisian and Schill present the country-to-country frequency distribution of overseas listing. US and UK exchange are the most popular host of overseas listing, probably reflecting the depth and credibility of these markets. Other important hosting markets include Belgium, France, Germany, Luxembourg, the Netherlands, and Switzerland, each hosting more than 100 foreign stocks. Out of the 260 Canadian overseas listings, 211 listings are on US exchange. New Zealand firms list heavily in Australia and vice versa. Sarkisian and Schill interpret this tendency implying that the same proximity preference that is believed to be responsible for home bias in portfolio holdings may also influence firms' choice of overseas listing venues. The London Stock Exchange is another popular venue across border listing. Many exchanges of the world are now competitive for cross-listing and trading volume of international stocks. Benefits from cross-border listing. The company can expand its potential investor base, which will lead to the higher stock price and a lower cost of capital. Cross-listing created as a secondary market for the company shares, which facilitates raising new capital in foreign markets. Cross-listing can enhance the liquidity of the company stock. Cross-listing exchanges the visibility of the company's name and its products in foreign marketplace. Cross-listing shares may be used in the acquisition currency for taking over foreign companies. Cross-listings may improve the company's corporate governance and transparency. Cross-listing may improve the company corporate governance and transparency. So, in a country where shareholders' rights are not well protected, and controlling shareholders like founding families and large shareholders derive substantial private benefits such as perks, inflate salary, etc., when the company cross-lists its shares on the New York Stock Exchange, London Stock Exchange, or other foreign exchanges that impose stringent disclosure and listing requirements, controlling shareholders may not be able to continue to divert company resources to their private benefit. Doge, Karogi, and Stulch argued that in spite of inconveniences associated with a greater public scrutiny and enhanced transparency, controlling shareholders may choose to cross-list the company share overseas, as it can be ultimated in their countries. The aforementioned study shows that other things being equal, those foreign companies that are listed on US exchange are valued nearly 17 higher on average than those that are not, reflecting investor recognitions of the enhanced corporate governance associated with US listing. Since the stock exchange also imposed stringent disclosure and listing requirements, Foreign firms cross-listing on the exchange may also experience positive revaluation due to the effect of enhanced corporate governance. Lynch and Miller in their study shows the cross-listing and exchange firms' value through improving the firm's overall information environment. Also enjoy great analytic coverage and increased forecast accuracy for firms' future earnings relative to those firms that are not cross-listing. That firms have a higher valuation, other things equal, and usually enjoy a lower cost of capital and better corporation governance. The most significant barrier to overseas listing. It can be costly to meet the disclosure and listing requirement imposed by the foreign exchange and regulatory authorities. Controlling insiders may find it difficult to continue to derive benefit once the company is cross-listed on foreign exchange. Once a company's stock is traded in overseas markets, there can be volatile spillover from those markets. Once a company's stock is made available for foreigners, they may acquire a controlling interest and change the domestic control of the company. Disclosure requirements appear to be the most significant barrier to overseas listing. Adaptation to U.S. accounting rules, which is required by the U.S. Securities and Exchange Commission, is found to be the most onerous barrier facing foreign companies that consider New York Stock Exchange listing. According to Glaume and Mandler, 1/3 of the German sample firms are in principle interested in U.S. listing, but view the required adaptation of financial statements of the U.S. generally accepted accounting rules (U.S. GAAP) as a major obstacle. Daimler, a German firm listed on the New York Stock Exchange, employs U.S. GAAP as well as a German accounting law and published two versions of consolidated financial statements which different report earnings. The company's net earnings were positive by the German accounting rules, but negative by American rules. Caroli considered that the cross-border listing of stock seems to have been on average positive NPV projects, based on a study in which she found that the share price reacted favorably to a cross-border listing. The total post-listing trading volume increased on average, and for many issues, home market trading volume also increased. Liquidity of trading in share improved overall. The stock exposure to domestic market risk is significant in the cost of equity capital of 114 basis points on average, and stringent disclosure requirements are the greatest impediment to cross-border listing. The International Asset Pricing Model is an extension of the Capital Asset Pricing Model that is applied to international investment. This model seeks to determine the expected return of an asset, taking into account not only the risks of the domestic market but also the risks associated with investment in different countries and currencies. The general formula of the IAMP PM is similar to that of the CAMP, but includes an additional factor for exchange rate risk. The IAMPM considers that investor diversity their portfolios internationally and are therefore exposed to additional risk, such as exchange rate risk, which must be compensated for with additional return. Given investor aggregated risk aversion measure that expect rates of return on an asset increase as the asset covariance with the market portfolio increases. In a completely segment capital market where no assets are internationally tradable, they will be priced according to their respective country systematic risk. By comparison, in fully integrated world capital markets where all assets are internationally tradable, each asset will be priced according to the world systematic risk for both domestic and foreign country assets. The asset pricing relationship becomes more complicated in partially integrated world financial markets, where some assets are internationally tradable, those that are cross-listed, while others are non-tradable. International tradable assets will be priced as if world financial markets were completely integrated, regardless of the nationality. Tradable asset will be priced solely according to its world systematic risk. Non-tradable assets, on the other hand, will be priced according to a world systematic risk, reflecting to the spillover effect generated by the main asset, as well as a country-specific system risk. Once the pricing spillover effect, non-tradable assets will not be priced as if world financial markets were completely segmented. The non-tradable assets are priced according to the indirect world system risk and the poor domestic system risk. The poor domestic system refers to those risks that are inherent to a company's internal operation and cannot be eliminated through diversification. Despite the fact that non-tradable assets are tradable only within the domestic country, then are priced according to an indirect world systematic risk, as well as a country-specific system risk. This partial international pricing of non-tradable asset is due to the pricing spillover effect generated by tradable assets. Although non-tradable assets are exclusively held by domestic local investors, they are priced partially internationally, reflecting the spillover effect generated by tradable assets. The cross-border listing of stock can help companies grow and expand internationally, offering opportunities for both investors and the companies themselves.